SummerSaaS. Time to pitch and have a blast.
Public markets are down, GDP's in red. The world's in disarray, everything is bad. With it being bottom, maybe not. Can the world come up with a counter-block? Many wonder how young startups are affected. Financial strength matters, which has been neglected. Will early stage startup valuations fall? Or as prices come back to roll? Many love hype, vision unicorns, but unicorns sometimes turn out to be stillborns. Want to survive, you need bowls of bread. That's why you should come and bitch us on the SummerSaaS.
3, 2, 1.
Hi everyone, that was my favorite song, definitely the tune of the summer. Welcome to SummerSaaS 2022. My name is Alex Konoplyasty. I'm the managing partner and co-founder of Flashpoint. It is our third annual online conference and we're highly excited to host all of you today. Let me share my presentation. So we have a very busy agenda today that includes a number of things. First, we have a pitch battlefield with 6 tracks and some great entrepreneurs. We also have a number of panel discussions with a number of great speakers joining us today. We also have networking lounges, so feel free to join in there. I'm very excited and hope that we can start our discussions very soon and hoping that you would find our event useful and would enjoy spending time today with us. Lastly, here I would like to thank all of our various sponsors and contributors. We would not be here without you today. Thanks to all venture capitalists and angel investors who have volunteered to participate in our panels and our juries. Thanks to all the founders who took time, despite their busy schedules, to submit their pitches and also go through the process together with us. And thanks to all the great Flashpoint team who put enormous amount of effort over the last 6 months to pull this event together, despite our busy schedules, and to make this happen. Moving on, as I mentioned, today or this time, this is the third time we're running this annual event. We're expecting over 1,000 participants this year, which should be record-breaking for us. And on the pitch battlefield, we have startups, about 30 startups representing about 15 to 20 different countries from emerging Europe and Israel. Over these years, we've been taking your feedback. Thanks very much for helping us to improve the event. And this year we have added a number of formats, including corporates and the startup alley. We're very excited to develop and improve. We have started SummerSaaS in the midst of the COVID crisis as a way to unite various investors, VCs, and founders from all over the Eastern Europe and Israel. As you can see from the numbers on this page, it is a very large ecosystem that has managed to produce over 100 unicorns in the last decade. Speaking of which, not many people realize that out of about 1,300 private unicorns at the end of 2021, about 10 to 15% were founded by entrepreneurs from our geography, from emerging Europe and Israel. A lot of these unicorns do change their nationality as they grow and expand to Western markets, move to the US, to London. They become, American unicorns, although we know their true roots. And definitely we want more of these to appear and grow together with us and amongst our ecosystem. And we definitely hope that our little event will be helping us all to move in that direction. Also to mention, there are over 60 VC partners representing emerging Europe and Israeli ecosystem. It's great that despite all the world's turbulence, you guys managed to gather here today. There's going to be about $10 billion of capital present looking for new innovation across emerging Europe and Israel. Not to bore you too much with macroeconomics, but on the other hand, would like to set the scene for the overall discussion today. Obviously, we all know that we operate in the changing macro environment. Main focus obviously is on the US economy, considering the impact on the overall VC markets, the amount of capital present there. A number of things to mention. Inflation has been a theme of the day. Now people are talking about stagflation. There are lots of fears that we're going to be heading in that direction. But obviously, inflation has heated up significantly, driven by surging consumer spending post-COVID, fueled fiscal stimulus before that. That collided with supply shortages, as we all know, from delays in our phone and car deliveries across other major sectors of the economy as well. More recently, obviously, this has been amplified by the general recovery in airfares, hotel rentals from their pandemic lows. Also, the Russian invasion of Ukraine and China's attempts to maintain a COVID-0 policy are extending supply shortages and heating up the inflation. In the US, many economists consider that the inflation is already peaking in April, May, so we should be seeing downward actually trend from there. In the UK, we're sort of getting closer to the peak levels. Europe is probably some months away from their peaks, but the overall expectation from the economists is that we should be peaking, and then the inflation should be slowly coming down towards the end of this year and going into 2023. Obviously, there's been a lot of talk about the commodity prices and energy prices, and we see it here in London quite a lot, prices going up. But looking at the US consumer, energy and even including food is a small percentage of the wallet share. Only about 12% of the wallet share of the US consumer is spent on energy and plus food. So overall, the impact, even if the prices are rising, the impact is not as terrible overall. The more important consideration is the labor market. Unemployment rate, as we all know, has been going down over the last years. It's now below 4%, and there are expectations that it could actually go down to closer to 3% towards the end of the year, which will be record-breaking since 1950s. Also, there is a massive excess demand for labor in the US economy, about 5 million more job openings than unemployed workers. And this excess demand, combined with the rising wages, fading pandemic effects on labor supply, will further lead to declining unemployment. As we know, in the U.S. economy, aging baby boom generation, limited immigration will continue to limit labor force growth over the years. So some economists fear that this will further put pressure on the upward inflation trend. The growth which we have seen over the last years has been in economies have been quite tremendous. Post global financial crisis, now growth is slowing down, as we all know, and being impeded by supply shortages and curtailed by new waves of the virus here and there in China right now. So it's widely expected that growth will continue slowing down as economy is reaching the capacity. So that's the overall expectation. Hence, we're operating in an overall, challenging and difficult macro environment. And on one hand, on the other hand, there are still multiple factors at play that could be, impacting and changing the outlook for 2023. Then, what does it all mean for the VC ecosystem? And we have a great speaker later on from Deal Room who will, talk more in more detail about various aspects and challenges of the VC market. But just to mention a couple of highlights here, 2021 has been a record-breaking year from VC perspective in terms of funds and capital raised into the funds. Over $100 billion of capital raised into the VC funds last year. Deal activity has, in absolute terms, reached also record levels, driven, as you can see from the chart on the top right here, driven mostly by mega rounds of larger, later stage companies. And as you can see, the number of the deals has not actually grown that much. So it's been growing steadily over the years. But what's been really growing is the average deal size along the valuation. So the median deal size last year was about $10 million, which was quite a substantial increase versus 2020 for early stage companies. And then for rounds of 50 million and more, or around 50 million, the average valuation was about $800 million versus about 450 in 2020. So significant increase in both the deal size and also the valuation going into 2021. As you can see from the chart on the bottom left, and as we all know and feel on our, in our portfolios, the valuations have come down quite significantly over the last 6 months, basically starting from roughly November, December last year. Crossover hedge funds who were one of the key drivers of these mega rounds and increases in valuation, considering their cheap cost of capital, now having all of the public portfolio pains, we see that they're not as actively involved in these later rounds anymore, and that is impacting the amount of capital available for the founders. Also, here we can mention that it's obvious that the year of hyper growth rewarded at any cost is quickly coming to an end, and we need to be rethinking our strategies on the fundraising side quite accurately. One interesting thing to mention, which I sort of didn't realize, for example, is that VC returns over time, and we give a chart here, or quite substantial period of time, have not been directly correlated with the interest rate environment and the inflation. So as you can see from the chart, interest rates have been going down substantially. Inflation has been sort of going up and down, but VC returns have followed their own cycles, tied, of course, to some macro shocks in a way, but considering the longer cycle of investment and longer cycle of building a company, the VC returns have been not as correlated. And then last thing to maybe mention on the overall sort of picture and environment, which we think is important, is the exits and exit environment. It has been tightening for obvious reasons in the last 6 to 9 months. The IPO activity has gone down substantially for obvious reasons. Hard to go public in the current volatility environment. Spark markets have been also hit quite badly on one hand. On the other hand, considering flat rounds or down rounds, even potentially for larger companies that have gotten to like this pre-IPO, IPO stage, and considering a significant backlog of the IPOs that got accumulated according to NASDAQ sources, actually there might be active IPO activity as the turbulence sort of subsides, maybe closer to the end of the year. In third quarter, people expect that a lot of companies might choose to actually go public instead of doing a flat round or a down round. So that would be interesting to observe how this situation will develop. I think in general it's good for the VC ecosystem, because more of these larger companies are becoming strategics and are gaining access to the public markets, becoming capable of raising capital and spur M&A activity for earlier stage companies. On SPACs, similarly, it's been a great run for this type of financing. It has dried out. Obviously, there was a lot of talk about how SPACs are differently regulated versus IPOs. So in March, SEC actually announced desire to additionally regulate disclosure and how projections are being displayed in the SPAC documentation. So that will put more pressure on the SPACs on one hand. On the other hand, there is hundreds of SPACs that are running out of time. So potentially also going into later into this year, early next year, as SPACs will need to de-SPAC, they might be more actively looking for opportunities. So that presents, for later stage companies also an interesting opportunity. So this is, from public perspective, but as we know, largely the exits are driven by the strategics, and for us as VCs, this is and for founders, of course, this is the main sort of path to exit the businesses that we've been invested for years. So from that perspective, one interesting point to note is that S&P 500 corporates currently have about $2 trillion of cash on their balance sheets, which is a mind-blowing figure. It's much more compared to the 2007 levels, pre-global financial crisis. It's about 30-40% more than what corporates had at that time. So actually, they do have relatively strong balance sheets, and also from M&A perspective and from the exit environment perspective, we think it's a positive sign. And then, what do we think and make out of all of this, macro picture, and how does it impact, our thinking and attitudes? First, macro requires more prudence and focus on efficiency of growth versus growth at all cost and hyper growth, as we have seen over the years. And we already see VCs focusing more on efficiency metrics rather than what has been happening before in the last couple of years, where growth was the key metric, how the company is growing. So founders need to consider the efficiency, think about the costs, think about the burn. M&As, should be carefully considered for later stage companies, considering the potential valuation to buy, but also how these companies could be integrated. On one hand, on the other hand, fundraising, as we discussed, has become more challenging in the lower valuation environment. So we need to be all thinking carefully about the fundraising strategy. What round size we're setting. What burn we're targeting, how much cash we should have on the balance sheet, and what is the potential valuation that we are targeting in our next round. On one hand, on the other hand, venture debt is becoming a viable option in the flat round or down round potential environment. Should be considered. Also, founders should be aware that in the current environment, for the fund managers, for guys like us, it's harder to raise capital. So there will be an impact down the road. Also, in previous crises, despite the committed nature of our capital and backlog of capital that has been sort of committed and accumulated, there were risks of redemptions from pension funds, etc., who decided to downsize their VC exposure and position. So we should be all mindful about that. But last thing to mention here is that we believe that actually now is the best time to start a company. That's why we are very excited to be here. And change, as we know, produces a lot of opportunity. And as we've seen in many past crises of 2008, great companies were born, like Airbnb and many others. Google was born in the dot-com bubble. So we think now is the time to start the company and see more unicorns appear from our geography. With that, I wanted to shift a little bit and talk a little bit about our selection process, how we have been trying to help, spearhead the effort of finding next unicorns from our geography. So we have run a rigorous process of selecting companies. We have looked at about 500 startups during first half of this year. We have in detail considered over 100 decks, basically, and we selected out of these about 30 companies that are going to be presenting today across 6 technology tracks. We have vertical and horizontal SaaS, we have developer tools, we have fintech, we have new economy, which could be an interesting one to discuss. A lot of controversies there, a lot of new ideas appearing, and also we have introduced the Ukrainian tech track. We have some interesting startups from Ukraine who will be presenting, and we're highly excited to support them. To support them today. And maybe lastly, to mention that a couple of words about Flashpoint. Some of you may know us. We are a tech asset management firm. We are focusing mostly on B2B software companies in Western markets, operating mostly in the US and Western Europe. But we're supporting founders who are either expats or originating from broader Eastern Europe, emerging Europe, and Israel. So this has been our focus over the last decade. We are a team of about 30 people. We are based in our main geographies of presence are London, US, and Tel Aviv, and then we have supporting offices across Eastern Europe. We have supported about over 50 companies in the last decade, active portfolio of about 40 companies today. Our portfolio has raised more than 1 billion of capital since our inception, and employs today about 2,500 people. So we're highly excited to work with all of these great founders and entrepreneurs and support these amazing teams. Just to give you some logos and pictures, as I mentioned, we have been very proud to support 50 to 60 companies, mostly in the B2B software space, but we occasionally also support companies that do marketplace or IoT businesses that are software driven, software first. We also have done a number of exits in the last decade, and highly excited to have been partners with these entrepreneurs and the funds. That concludes my speech, and I thank you very much for your attention. And again, thank you so much for joining us today.